Something very important just happened in the gold market, and it's not just another bank raising a price target. Goldman Sachs, one of the most influential financial institutions in the world, has just raised its 2026 gold price target to $5,400 per ounce. Let that sink in. This isn't a speculative newsletter. This isn't a retail hype call. This is Goldman Sachs. And what makes this move so powerful is why they're doing it. Because according to Goldman, this rally is no longer being driven by fear alone. It's being driven by structural change from $4,900 to $5,400 in just weeks. Just weeks ago, Goldman Sachs had a year-end 2026 gold target of $4,900 per ounce. That already sounded aggressive. Now they've raised that forecast by more than 10%, pushing it to $5,400. That kind of revision doesn't happen casually. Banks don't raise targets like this unless something fundamental has changed, and something has. The big shift, private investors are now in. For years, the gold story was dominated by central banks, emerging market central banks, reserve diversification, de-dollarization, geopolitical hedging. But now Goldman Sachs says the private sector has joined the trade, and that changes everything, because private capital is bigger, faster, and more persistent. Why this is different from past gold. Hedges. Goldman makes an important distinction here. In the past, many gold positions were event-driven. People bought gold ahead of elections, ahead of referendums, ahead of temporary policy shocks. And when those events passed, positions were unwound. This time is different. The new hedge, fiscal sustainability. According to Goldman Sachs, investors are no longer hedging events. They're hedging systems. Specifically, fiscal sustainability, long-term debt trajectories, monetary credibility. These aren't risks that resolve in 6 months. These are risks that linger for years. That's why Goldman calls these positions stickier. Sticky capital is a gold market game changer. Sticky capital doesn't trade headlines. It doesn't flip overnight. It accumulates, holds, and defends its position. When investors buy gold because they no longer trust long-term fiscal discipline, they don't sell just because inflation ticks down 1 month. This is a slow burn reallocation, and that's exactly what Goldman is seeing. Central banks are still buying aggressively. Even as private investors step in, central banks are not backing away. Goldman Sachs expects central banks to buy an average of 60 to 70 tons of gold per month in 2026. Put that into perspective. That's nearly 4 times the average monthly buying seen before 2022. This is not normal behavior. This is strategic behavior. Why 2022 changed everything. Goldman highlights a critical moment, the freezing of Russia's foreign reserves in 2022. That event permanently altered how emerging market central banks view risk. It proved that reserves held in foreign currencies can be politicized, frozen, or seized. Gold can't be frozen. Gold can't be sanctioned. Gold doesn't rely on permission. China's quiet gold problem. Goldman also points out something fascinating. China's official gold reserves, as a share of total reserves, are still low compared to global peers. And yet, China wants to internationalize the yuan. Those two facts don't align. If China wants global trust, it needs stronger reserve backing. Gold fits that role perfectly. ETF flows are already surprising. Goldman, here's another key detail. Western gold ETFs have already added around 500 tons since early 2025. That's far more than Goldman originally expected, even accounting for US rate cuts. This tells us something important. Gold demand is no longer just policy-driven, it's trust-driven. The debasement trade is back. Goldman Sachs openly acknowledges the return of the debasement trade. High net worth families, private wealth, institutional option buyers. They're all positioning for long-term currency erosion, not hyperinflation tomorrow, but slow, relentless devaluation over time. Gold thrives in that environment. Why risks are skewed to the upside. Goldman makes a bold statement. They say the risks to their $5,400 forecast are significantly skewed to the upside. Why? Because private investors may continue diversifying further if uncertainty lingers. And uncertainty is lingering. What could hurt gold? Goldman is clear. To be fair, Goldman does acknowledge downside risks. A sharp reduction in perceived long-term fiscal and monetary risk could trigger liquidation. But ask yourself honestly, do you see governments cutting debt meaningfully? Central banks regaining full credibility? Geopolitical tension disappearing? Because Goldman doesn't. Gold is their favorite commodity. Period. In their broader commodities outlook, Goldman Sachs is clear. Gold is their single favorite long commodity. Not oil, not copper, not lithium. Gold. That alone should get your attention. Why commodities matter more than ever. Goldman also emphasizes something broader. Commodities aren't just trades, they're insurance. Supply chains are concentrated. Geopolitical leverage is increasing. AI and tech competition is accelerating. In that environment, commodities protect portfolios in ways stocks and bonds cannot. The hidden risk in 60/40 portfolios. Goldman delivers a quiet warning. Traditional equity bond portfolios are not well diversified when commodity supply shocks occur. In those scenarios, growth weakens, inflation rises, stocks fall, bonds struggle. But commodities, especially gold, perform. This is not a gold bubble. Call. Let's be clear, Goldman Sachs is not calling a bubble. They're calling a repricing of risk, a repricing driven by structural reserve diversification, private sector capital rotation, long-term fiscal uncertainty. Those forces don't unwind easily. Final thought for part one. When central banks buy gold, it's strategic. When private investors join them, it's transformational. Goldman Sachs sees that transformation happening right now, and that's why $5, $400, $100 is no longer a stretch. It's a baseline. Now here's where this story gets even more interesting. Because when Goldman Sachs raises a gold price target, they're not just looking at charts. They're looking at power. They're looking at who controls resources, who controls money, and who controls trust. And that's where this cycle starts to look very different from anything we've seen before. Gold is no longer just a hedge, it's a strategic asset. For decades, gold was treated as a defensive hedge, something you own just in case. But Goldman's language tells us something has shifted. Gold is now being treated as a strategic allocation, not a trade, not a fear response, but a core holding in a world where economic rules are changing. The US-China power race changes everything. Goldman explicitly links the gold bull market to the US-China geopolitical and technological power race. This matters more than most people realize, because this competition isn't just about chips, AI, or military hardware. It's about who sets the rules of the global system, and commodities sit right at the center of that battle. Why gold benefits from AI and tech competition. This may sound counterintuitive at first, but AI dominance actually strengthens the case for gold. Why? Because AI accelerates energy demand, resource concentration, supply chain fragility, and that increases geopolitical leverage over commodities. Gold becomes the neutral asset in a world where everything else is politicized. Commodity dominance is becoming a weapon. Goldman makes a critical point most headlines ignore. Commodity dominance is increasingly being used as geopolitical leverage. We've seen it with energy, food, rare earths, and now precious metals. When supply is concentrated, the risk of disruption rises. And when disruption rises, the insurance value of gold explodes. Why equity and bond portfolios are exposed. This is one of the most important warnings in the entire Goldman report. They explicitly say that equity bond portfolios are not well diversified in today's environment. Why? Because when commodity shocks hit, growth slows, inflation rises, bonds lose their hedge function. That's a dangerous combination. Gold fills that gap. This is a structural reallocation, not a trade. Goldman keeps emphasizing one word: structural. Structural diversification, structural reserve changes, structural demand. That tells us this isn't a momentum chase. It's a slow, grinding reallocation of capital away from promises and toward things that cannot be printed. Why central banks won't stop buying. Let's come back to central banks for a moment. Goldman expects 70 tons per month in 2026. That's not tactical buying. That's policy-level behavior. Once a central bank starts diversifying into gold, it rarely reverses course. They accumulate, they store, they hold. And they don't care about short-term price volatility. The private sector is following the smartest money. This is the most important signal in the entire report. Private investors are now doing exactly what central banks are doing. They're not chasing returns, they're hedging systems. That alignment between public and private capital is rare, and when it happens, it tends to last. Why Goldman sees more upside risk than downside. Goldman doesn't just say there's upside. They say the risks are significantly skewed to the upside. That's a strong statement. It means they see more scenarios where gold goes higher than lower. They see more capital waiting to enter than exit. They see more reasons to hold than sell. Banks don't use that language lightly. What would actually break this bull market? Let's be honest. What would it take to reverse this trend? A credible plan to reduce global debt? A restoration of trust in long-term fiscal discipline? A reduction in geopolitical fragmentation? None of those are visible right now. That's why Goldman is reassessing their own forecasts. Why $400 might be conservative. Here's the uncomfortable question. If central banks keep buying, private investors keep diversifying, rates ease further, geopolitical uncertainty persists, Then what actually caps gold at $500 to $400? Goldman hasn't answered that yet. And that silence speaks volumes. Silver and the commodity ripple effect. Although this report focuses on gold, the implications extend further. When gold moves structurally higher, it pulls the entire commodities complex with it. Silver, platinum, industrial metals. Gold sets the monetary anchor. Everything else reprices around it. This is about trust, not price. At its core, this gold move is not about inflation. It's about trust. Trust in currencies, trust in institutions, trust in long-term policy. When trust erodes, gold rises. Not explosively at first, but relentlessly. The new role of gold in portfolios. Goldman isn't suggesting a speculative bet. They're suggesting a strategic allocation, a role for gold as bias in insurance, diversification, stability. In a world where volatility is no longer episodic, so permanent, the quiet message. Behind the headlines. If you strip away the numbers, Goldman's message is simple. The old framework is breaking, and gold is one of the few assets built for what comes next. That's why it's their favorite commodity. That's why they're raising targets, and that's why they're warning that the upside may not be done. Final thought. When one of the world's most influential banks tells you that, central banks are still buying aggressively. Private investors are now joining them. Fiscal risks are unresolved. And uncertainty is structural. You should listen carefully, because this isn't a prediction, it's an admission. Gold isn't rising because something is wrong tomorrow. Gold is rising because too many things are wrong for too long, and that's why $400 may not be the destination. It may just be a checkpoint.